Thanks for taking the time to come here on a nice Sunday morning. I have a lot of content to cover today, so let's get started right away. Here are some disclaimers. So here were our predictions last year, same time at the show. We were expecting a weaker US dollar, and we were expecting commodities to strengthen across the board last year. And here's what happened last year. Pretty much all the mainstream commodities except zinc were up. On average, commodity was up 16% year over year, but the US dollar is up 2%. Keep in mind that the US dollar has been depreciating the last 3 months by 2%. And that said, we continue to believe that the US dollar will weaken over the next 12 months. And I have 4 reasons for that. Number one, this table shows here the expected GDP growth rate of all the main regions. The US is the only region that is expected to have a weaker GDP growth. Number two is an inverted yield curve. The US experienced an inverted yield curve for a brief period in 2019. The inverted yield curve, what it means is that people demand long-term bonds versus the short-term bonds, and that's because of the uncertainties in the market. And the beauty of yield curve or negative yield curve is that they've always predicted a recession. A recession has always followed a negative yield curve within 12 to 18 months in the last 50 years. The third factor is record high stock valuations in the US. As you can see here, the US stock market is trading at much higher multiples than other regions, so we expect a recession might be overdue there. And the fourth reason is moderate inflation levels. So at 2.3% inflation December last year, the US has experienced moderate inflation, which means that the Fed might maintain or even drop interest rates in the next year. So these factors lead us to believe that the US dollar could depreciate in the next 12 months. So moving on to the main topic of the day, which is electric vehicle and their batteries and the inputs. Quick question, how many of you own an electric vehicle today? So that's 0%. If electric vehicle prices are comparable to gasoline or normal cars, how many of you will be inclined to buy or look into buying an electric vehicle? So that's 30% now. So what the key matter is the battery costs and the price of EVs is the biggest deterrent in the market today. And that's the number one reason why we believe that EV or batteries will have an exponential growth, which is the decline in battery cost. In the last decade, battery costs were down 85%. Cost as a percentage of the price of a car was 50% in 2015. This is now about 35%, and this ratio is expected to go to 25% by 2025. And here's the most important chart, which is in 3-4 years, the cost of EVs is almost going to be comparable to conventional cars, and that's going to keep declining beyond that, which we believe will result in a significant increase in demand. The Bloomberg Finance estimates that about 55% of new cars by 2040 will be electric vehicles. The current demand for electric vehicles is about 5 million cars a year. This demand is expected to go to 23 million vehicles, and that's by the IEA, International Energy Agency. Bloomberg actually has a more optimistic forecast, which is 40 million or 30 million by 2030 and 60 million by 2040. These are exponential growth rates. So how do we take advantage of this growth rate, which is look into lithium-ion batteries, what is the composition of these batteries, and let's take a look at supply demand of each commodity. This chart here is pretty good. It shows the 5 different types of LiPs or lithium-ion batteries out there. The first 3 ones highlighted use cobalt. The first 2 include nickel and cobalt. And the last one, which is a lithium iron phosphate, which is the biggest battery type in China, which is the biggest producer, they don't use they don't use nickel or cobalt, but they use lithium. Now, the biggest shift we are seeing in the market today is the LFPs, the ones used in China. They're moving towards the NMCs, which is the first one there. NMC is nickel, manganese, and cobalt. So when there's a shift from demand from LFPs to NMC, we're going to see a rise in demand for nickel, cobalt, graphite, and lithium. And I'm going to say why. This is a forecast by McKinsey on the expected battery types over the years. And as you can see here, by 2030, we're going to see over 75-80% of NMCs out there, which use all the four inputs that I'm going to talk about in a second. And that's this one. In a battery, lithium is used as an electrolyte, and graphite is used as an anode, and that's the negative side. And cobalt and nickel are substitutable, and they are used as cathode on the positive side. Here is how much of each commodity is used in an electric vehicle. Cobalt is 10 kilograms, lithium is 20, nickel 30, and graphite is the most used. It's 75 kilograms a car. Now, applying the 23 million vehicles forecast, which I mentioned earlier, how does it relate to the demand for each commodity? This, I would say, is the most important chart in my presentation today, which is cobalt at 23 million vehicles. There should be another new demand for 170,000 tons of cobalt. The current demand is only 100,000 tons. What that implies is that within 10 years, cobalt demand will be up 150%. Lithium carbonate, applying the same methodology, should be up 150%. Graphite should be up 120%. Nickel is already a big market, 1 million tons of nickel used, of which we think another new 30% demand is expected over the next 10 years. So let's look at the supply side of each of these commodity and see if there's any bottleneck or any problems with this supply to see which of these commodities will be the best performer. Starting with cobalt, more than 60% of the demand comes from the DRC, which is highly unstable, and they're famous or notorious for bad child labor and unfavorable mining conditions. But I put together a chart here which shows the projects in worldwide outside the DRC that could supply cobalt. And as you can see here, the total resource adds up to only 400,000 tons, which is under 3 years of expected cobalt supply. So even if all these guys are in production, cobalt demand cannot be met. And this is a chart from the Citigroup. The current market is in a supply surplus, which means supply is higher than the demand. But by 23-24 is when we are going to see an expected deficit in the market. So unless these projects come on stream, we're going to see a massive shortage in supply. Moving on to graphite. Graphite is a slightly different animal in terms of about 60% of the market comes from synthetic. And right now, and among the natural, about 60% of the graphite market, we call this flake graphite, can be used for batteries. So keep in mind, flake graphite and synthetic can be used for batteries. Let's look at where flake is coming from, mostly from China, and most of it, China is experiencing a decline in production in flake graphite. So what we are looking at is, what's the price of synthetic graphite and what's the pricing of flake graphite, which can be used in battery, and let's take a look at that. So if flake graphite is priced at $1,000 a ton, the cost to convert flake graphite to battery level graphite or spherical graphite is about $6,000 a ton. So if you add up, the price to convert natural graphite to battery level graphite is about $7,000 a ton. Synthetic graphite is trading at $10,000 to $20,000 a ton. So clearly there's a benefit for good quality flake graphite projects. So we think that the graphite pricing could be as high as $3,000 a ton to make it comparable to the synthetic graphite. Current price of graphite is at $1,500 a ton. This is a forecast from Benchmark. They expect the market to be in deficit by 2024, 2025. Like cobalt, the market is right now in a surplus, but we expect a deficit in the next 4 or 5 years. Moving on to nickel, right now, the market is in a deficit, and the deficit is expected to increase over the next few years. But consensus says that the nickel price has to be close to $9 a pound for most of the projects to be economic, so that new supply can come into the market. So we took a look at that, at the biggest projects in Canada. These are some of the large projects in Canada, nickel projects. And we found that their economic studies, when they apply $775 to $850 a pound, right now nickel is at $690 a pound, Even if you apply $850 a pound, the internal rate IRR is only 13 to 15%. You can see in the red thing there. And that is not enough for producers or developers to advance a project. So we believe that prices have to be significantly higher than the $8 per pound mark for nickel projects to be advanced. Moving on to lithium, last few years, prices have done so well. As a result, exploration spending has been increasing dramatically, which has resulted in a lot of discoveries. And as you can see here, there's now a strong pipeline of supply of lithium. And unlike the first three commodities, we are not going to see a deficit until 2030. But here's the catch. As I mentioned earlier, lithium right now, the production is about 800,000 tons. And the demand we expect will be going to 1.5 million tons. This chart is beautiful. Why? Because if you see on the right side, I've circled there, production over 500,000 tons per year, the cost to manufacture is $8,000 to $10,000 a ton. Current price of graphite is $10,000 a ton, which means that prices have to be above the $10,000 per ton mark for developers and producers to advance the graphite projects that they have, flake graphite projects, to make it economic. So even though the market is in a surplus now, prices have to stay over $10,000 a ton, which is the current price, for projects to make it attractive for producers. Overall, we have a positive outlook on the market. All the inputs we have, we think over the next 10 years, we are going to see an increase in demand. And if the projects are not advanced, or if high quality projects are not advanced on a proper timeline, we're going to see a deficit in supply. So in terms of what we think in the near term, which commodities perform well, we think based on the supply demand, we think cobalt should move up faster than nickel, graphite, and lithium. With that said, I'm going to mention a few commodities, or a few companies that we cover in each space so that you can get an idea on if that fits your investment criteria. Number one is cobalt. This is the company called Fortune Minerals. It's the largest, or one of the largest, primary cobalt deposits in North America, advanced stage project. They have about 85 million pounds of cobalt in reserves. Economic study done on them showed an after-tax NPV of 220 million US. This project also has 1 million ounces of gold, and they are in the Northwest Territory in Canada. Moving on to nickel, I have two companies. One is a large nickel sulfide project. It's one of the largest in the world. It's called Giga Metals. The company is trading at $16 million enterprise value, and an NPV, after-tax NPV on the project alone, is $700 million. And that is based on 5 billion pounds of nickel. The other project is much smaller, about 200 million pounds of nickel with $200 million capex, and the after-tax NPV is almost $100. The company is currently trading at just $5 million. And if you look at the price per enterprise value, both companies are trading at under 5% of their after-tax NPV. Moving on to graphite. Graphite One holds one of the largest, or if not the largest, graphite resource in North America. They're in Alaska. The Alaskan government recently nominated Graphite One project as a high priority infrastructure project. Again, this is also an advanced stage project. The NPV was close to $650 million, and the market cap of this company is under $15 million. Over the next section, I want to talk about 4 companies that will be 4 new ideas that we will be initiating coverage shortly. This company, Golden Minerals, we just launched coverage actually yesterday. The other 3 we are going to initiate in the coming months. But starting with this company, they have 3 projects with resource estimates. Their most advanced stage project in Argentina has an after-tax NPV of 45 million. The company's market cap is $30 million. But here's the beauty of it. Their project in Mexico has 2 mills that can process ore for third party. We think the revenues from these 2 mills can alone be $12 million with an operating profit of $8 million. So with just by those 2 mills that can generate $8 million in operating profit, we think the company is significantly undervalued. The next company is Rockcliffe Metals. They have their project in one of the largest or the most attractive VMS deposits or the regions in the world, which is in the Flin Flon belt. And they have high-grade near-surface projects. And here's why, the biggest reason why we like the company. The company has over $20 million in cash, but the market cap is also just 20 million, which means the enterprise value is almost zero, or the market assigns zero value to any of the projects that it holds. Third company is Cornerstone Capital Resources. They have a partnership with Sol Gold. Combined, these two companies owns one of the largest undeveloped deposits in the world, which is in Ecuador, called the Cascabel project. They have over 90 million ounces of gold, almost 19 million pounds of cobalt. Obviously, the capex is huge because it's a large project, and the after-tax NPV on this project is over $4 billion. We think Sol Gold or the project itself could be a good acquisition target, which would help Cornerstone. And the final company, Benz Mining, micro-cap, small company, high-grade project, over 8 grams per ton in Quebec. They have a resource estimate there, and the company is currently trading at $8 an ounce versus the average multiple of $64 an ounce in that region. Finally, I want to end this presentation with one of our top picks. It's called Gran Colombia Gold Corp. They have 2 operating mines in Colombia. They are the largest Colombian gold producers. 2 weeks ago, they came up with their year-end results, which beat our estimates, and that's 240,000 ounces of gold in 2019. And look at the valuation multiple. The enterprise value to revenue is 0.8 times. The gold industry is trading at 2.9 times. The other multiple is EV to EBITDA, which is 1.8 times. The gold industry is trading at 7.7 times. Company is spinning out one of their existing mines to a new entity, and they're going to get shares for that. And we believe this is a company that should be, monitored. But to get a hold of other topics, please come by our booth. I'll be there all day, today and tomorrow. Feel free to ask questions, and then hope you have a good show.